Are you living in a wealth gap? Well, today I'm going to show you how we can close wealth gaps in housing, for our children, and in retirement. So stay tuned. I'm going to show you how, plus bonuses on how the country can close some of those wealth gaps as well. And it's been proven around the world. How to close the wealth gap in housing. Today we're going to look at this from a personal finance and a historical perspective. In a 2016 survey of consumer finances by the Federal Reserve Bank, it showed the median family wealth for white households was $171,000. For black households, $17,600. What a gap. Wealth is calculated as the total value of assets such as real estate, stocks, bonds, cash, a person owns minus their debt. Wealth is important because it allows people to maintain a standard of living even if they're not receiving a paycheck from a job. We're going to look at the housing wealth gap, actions you can take now, and finally a way to practice wealth resiliency. Welcome to What's Next with Money, a program about recognizing and moving on from financial regret, missed opportunities, and bad advice, because within these crises lie the seeds of learning and hope. This program holds the promise of second chances, strategies for growth, and financial empowerment. Let's get started. To look at the wealth gap, we look at wealth inequality in the U.S., and it's often an unequal distribution of assets among residents in the United States. Nothing can really be equal, but sources that study the wealth gaps are here on the split screen. The wealth gap exacerbates many inequalities. Class immobility. Sometimes it's the idea that one's birthplace and zip code equals one's destiny. Racial disparities are not just in housing, they're in health, education, and income. Now, progressives advocate greater equality at the finish line, also known as equality of outcomes. Conservatives may look at equality at the starting line, known as equality of opportunity. We have a viewer question here from Sheila. And Sheila asks, what are the historical origins of wealth gaps and inequality in America? Well, thanks, Sheila. There are many sources, and with an eye toward history, we see several starting points, both structurally and systemically. Slavery. It's a world of non-ownership. The enslaved people were the property. After the Civil War, the Freedmen's Bank was set up as part of the Freedmen's Bureau to bring financial literacy and empowerment to newly enfranchised former slaves. But unfortunately, President Lincoln was shot, and the implementation of Reconstruction was uneven and incomplete, done under by political and racially charged forces designed to block opportunities for African Americans. Here's another example. After the Civil War, General Sherman concluded that each black family should receive 40 acres. Sherman signed a field order allocating 400,000 acres of confiscated Confederate land to black families. This is the 40 acres. You've heard of 40 acres and a mule, and the mule came from surplus mules from the Union Army. Yet after President Lincoln's assassination, the new president, Andrew Johnson, reversed the 40 acres and returned all that land back to the former slave owners. Then for decades, as Reconstruction restarted and then failed, we had the Jim Crow era, the time of black codes, and even moving up to the New Deal, resulting from the Great Depression. The Social Security Act was started. But for instance, it initially excluded agriculture and domestic workers who were disproportionately black. After World War II, the GI Bill offered college tuition and home loans and unemployment benefits to white veterans while excluding black veterans of some benefits. And the reason it happened this way, the GI Bill was implemented locally. Also, the Federal Housing Administration around this time instituted redlining and fomented racial housing segregation and racial covenants? Well, thanks, Sheila, for that question. There's a lot of history here, and it continues. Be sure to hit that subscribe button and send us a question. You can do that at whatsnextwithmoney.com, our website, or at the link below in the comments section of this channel. We're talking about how to close the wealth gap in housing. Here's Area 2, actions you can take now for asset and wealth building. Check this out. Home ownership is the largest component of wealth for American families. A 2019 U.S. Census said that the home ownership rate for white non-Hispanic Americans was just over 73%. Now compare that with Black Americans at just over 42%. That is a big, big gap. Other rates, still a gap. Hispanic and Latinos, over 47%. American Indians and Alaska Natives, over 50%. Asian and Pacific Islander, just over 57%. Okay, another way to look at this. The average housing wealth for white families was more than double that of Black or Hispanic families in 2016. So what's going on here? According to Brendan O'Flaherty, a Columbia University economist, white families are more likely to trade up to pricier homes over time, whereas Black families, on average, this is just average, there are many, many exceptions, Black families are more likely to lose their home or stay in the same house for a lifetime. Now, there may be a slight upside opportunity here for asset building because of urbanization and gentrification, but that's a double-edged sword. It can increase real estate values for owned homes in some minority neighborhoods. But here's the downside. The home and its owner, who could even be an elderly minority person with little cash, is vulnerable to refinancing schemes, excessive refis, and buyout offers for cash from real estate investors, or worse yet, scammers. The gentrification of cities creates involuntary displacement in many cases. And it's not just cities. In rural areas, the industrialization of farms on minority-owned and legacy land. This can be legacy land passed down many decades, and in case over 100 years. Land that's been collectively owned by family members. So what do we do in housing to build wealth? How do we protect ourselves? First, get housing counseling. Get help with credit scores, credit reports. The lower the score, that equates to higher cost of financial products, higher interest rates. Your cost of just ownership is so much higher, and it creates a big budget squeeze. Understand the role of down payment assistance programs. These can be found at local housing agencies. And try to build equity and savings, a key to not being on the edge and vulnerable in a downturn. Be aware of over-leverage and predatory lending practices. Minorities have lost housing wealth because of highly leveraged and predatory lending, structurally bad mortgage loans during the financial crisis. This was a huge financial setback. So it was one step forward and two steps back, often resulting in the loss of the home. So what's my housing point? Today, we have a wealth divide of ownership versus non-ownership. And I am not in any way saying everyone needs a house or to have home ownership, but at least have the ability to build ownership, some capital in transportation, retirement savings, and emergencies to get the training and education one needs, to not live paycheck to paycheck. Also think about small business and the gig economy. Consider the inventiveness and the entrepreneurial heritage of minority groups in America. It is legendary. Money is a tool, not an end game. But I am advocating broader ownership, economic participation, and wealth creation among all Americans, and to, bottom line, not lose any house in a downturn. So please consider hitting that subscribe button. And did you know you can get free personal finance insight in a 6-page PDF, go to the link below or whatsnextwithmoney.com. So we're talking about how to close the wealth gap in housing. Let's reflect for a moment on the modern civil rights movement. We think about desegregation, equal access of public and private facilities. But to much of the latter part of the movement, and my work as a volunteer years ago with the Kentucky NAACP, was about access and redress of economic pressures and blocked opportunities. Remember when Dr. King was assassinated, he was focused on fair and open housing and the plight of striking garbage workers in Memphis. And then there was the emergence of the Poor People's Campaign that later was held after his death in Washington. The work of his deputy and the later mayor of Atlanta and UN ambassador Andrew Young negotiated with a white business community to open up economic markets and opportunity and ownership. The buying power of any minority group. It's not about black, white, brown. The operative color is green. Wealth creation is playing offense, and wealth preservation strategies is playing defense. We need in America to do both to help close that gap. And we're talking about how to close that gap in housing. And the third and final area is practice wealth resiliency. Here's my point. In a financial or a housing crisis, market panics, natural disasters, try to choose not to participate. That sounds strange, but I am serious. Fortunes and opportunities abound in a recession. Costs are lower. It's a great time to start and grow a business or seek investments. I've been able to do both. Why have a recession or a market downturn be remembered in one's family for the loss of ownership or a loss of assets? It should be a time to pivot and acquire, but no matter, certainly defend what you own. Protect what is yours, whether it's a retirement account when you switch jobs, hang on to what you saved, roll it over to an IRA or into a new 401k at your next job. And especially for housing, defend your family assets. Come up with a strategy to enhance and protect that home. Using savings reserves, it may need to be pooling money from many others in the family to save the family asset, that home from foreclosure, to save grandmother's house, and use it in the future to build wealth. Write down what you and other family members did that worked or did not work in the last downturn. If it did not work, do the opposite. Do the opposite strategy. If something did work, build upon it and seek the advice of practice investors and professionals you trust. We're always going to have market events, a housing crisis, and in this last one, minorities were hit especially hard. It widened that ownership and housing gap. And there's the danger of refinancing, of home equity leakage. Many bad things happen then. Market panics widen wealth inequality. Being aware of these changes is the first step in surviving and thriving in downturns without the setbacks of turning over and losing wealth. The stakes are high, the gap is wide, and downturns make them worse. There are ways to prepare to defend and grow assets and grow ownership, and to, in some way, try to close part of that wealth gap. Be sure to hit that subscribe button at What's Next with Money. We are here to provide some of those tools, those ideas and connections to build ownership and to help close these incredible gaps of wealth and ownership in our society. As we look to close the wealth gap for our kids, there's a new proposal in the federal government called Money Growth and Advancement Accounts. Money Account for Growth and Advancement. The abbreviation is MEGA. If you file taxes, $1,000 is going to be deposited for a kid until they're 18, and then they can take that money out for prescribed purposes like education, training, at a tax-deferred rate. So finally, folks are catching on to this new idea in Washington. How to close a wealth gap for your children. These are actions you can take now to give them an edge on tomorrow, strategies you can plan for tomorrow. We're going to give you 2 ideas that are being talked about to plug the wealth gap for America's children, and 2 ideas that you can implement now for them. Kids and money is not new in the financial world. There are many great books about personal finance and raising kids, and I had the privilege a few years ago of working with Sesame Street as part of the National Endowment for Financial Education on this program that Elmo did called For Me, For You, For Later, dealing with spending, savings, and sharing. I'm going to have a link to that program down at the bottom of the comments section. Welcome to What's Next with Money, a program about recognizing and moving on from financial regret, missed opportunities, and bad advice, because within these crises lie the seeds of learning and hope. This program holds the promise of second chances, strategies for growth, and financial empowerment. Let's get started. We're going to give you 2 ideas being talked about to close the wealth gap for your children, and 2 ideas you can implement now. From the study by the Children's Defense Fund, State of America's Children 2020, they noted the ever-increasing wealth inequality or wealth or ownership gap. And you might say, wait a minute, kids can't really legally own anything. Well, that's partially true. It often has to be in the name of the parent. But wealth or net worth refers to the total value of a person's or a family's money, the property, what they own, minus their debts, what they owe. Like income inequality, wealth inequality has been rising for decades. And today, wealth is more concentrated than income. For example, the average Black family had 23 cents of wealth for every dollar of wealth held by a white family. Now, this comes from the Center for Household Family Stability at the St. Louis Federal Reserve. For Hispanics, it was 20 cents to every dollar held by a white family. And as we've covered before in our What's Next with Money, how to close the wealth gap in housing, the racial wealth gap is the product of centuries of racial discrimination that have denied families of color the opportunity to build wealth. And some of these came by actual policy choices by the government. So here's the first idea that are being talked about to close the wealth gap for children. This is a policy concept. It's called Roth at Birth, like the Roth IRAs, Roth at Birth. This is the idea that the government could create an investment account for infants, giving babies born to poor families large seed grants, or babies born to rich families smaller ones. That's called means testing. The money would grow and the kids would gain access to it when they reached adulthood. It could be used for school, a house down payment, or even a startup. Now, savings is ownership, and there is power in owning. These are like child savings accounts. And there are some around the country. One in the San Francisco area is called Kindergarten to College, or K to College. And this is a starter account where seed money is actually granted, and it's an account for kids that they can use for education. So this idea is being studied and is emerging around the country, but not really on any grand scale right now. But why is this important? What are we talking about? It's not just the power of financial literacy, but it's the power of ownership. In a 2010 research study published by the School of Social Work at Washington University in St. Louis, they found that children who have college savings accounts, now get this, are almost 7 times more likely to attend college than children without an account. Having a savings account, the study found, was a better predictor of whether a child would attend college more than race or the parent's net worth. This is astounding. So the Roth at Birth concept, even if the government stepped in and made them possible, they don't necessarily have to be seeded with government money. Just the act of changing the rules of existing Roth accounts can make a difference. And this was found in a research paper done by Ted Beck, former president and CEO of the National Endowment for Financial Education, and Ray Bashara, a senior leader at the Federal Reserve Bank of St. Louis, that's Center for Household Family Stability. Now, what's the point? They said there's a national opportunity now to leverage the simple fact that early savings in a child's name promotes financial capability. And as we've just seen from this study, promotes college graduation or college attendance, and down the road, even retirement security. And one of the greatest resources youth have is the time value of money, the miracle of compound interest. Embedding wealth accumulation at birth into tax-favored savings accounts can add 18 to 30 additional years of compounded interest to the value of young Americans' net worth. And that's what Ray and Ted found in their analysis paper, as well as creating and improving positive behaviors, financial behaviors, over the young person's lifetime. A Roth at Birth account could be created by a simple modification of the current earned income rules for existing Roth IRAs. It would allow children to use their parents' earned income limits to make contributions. And you might say, well, how are these going to be made? They could come from the parents, the child's earnings. Also, grandparents could contribute. Money could be pooled by many family members, and it could grow tax-free. Again, it can be used for higher ed, first-time home purchase, medical expenses, retirement, or other expenses. And another easy source would be a tax refund. The IRS allows any American to split their refund and to have some of that moved to a savings or a retirement account. Employers could be encouraged to set up automatic payroll deductions. Schools could even have a way to work with participating financial institutions to open Roth at Birth accounts for every child, perhaps when they enter kindergarten. And there is even a concept, a Roth at Birth account could be opened simultaneously when the parents obtain the child's social security number. All these are very innovative and doable policy ideas. What could you do right now to close the wealth gap for your children? Here's the first actionable idea you can implement now. Set up a Roth IRA for your kids. Now, they have to earn money. That's the way it would happen, but there are no age restrictions. Kids of any age can contribute to a Roth IRA as long as they have earned income. Now, a parent or other adult will need to open the custodial Roth IRA account for the child. We have a viewer question here from Allie. And Allie asks, is the financial services industry interested in these Roth at Birth accounts? And the answer is yes, according to some of these studies. The financial services industry sees the potential of this low-risk method to build customer relationships as early as birth while engaging the entire circle of a child's parents and relatives. Now, some of these accounts are available now with no investment minimums or annual fees. And some you could start maybe with $500 or even $100. And we want to hear from you. And Allie, thanks for your question. If you have a question, you can send it to us. Go to the link below in the comments section or send a question through whatsnextwithmoney.com, our main website. We want to hear your thinking. We're here talking about giving you 2 ideas being talked about to close a wealth gap for your children, and 2 ideas you can implement right now. Well, here's the second new idea, policy idea being talked about, and it's been around a few years: baby bonds. Now, we're not talking about Boss Baby. These are baby bonds. Baby bonds address pressures many minority families are feeling regarding eroding wealth accumulation. Now, a study by Derek Hamilton at Ohio State and Samuel Cook at Duke University has looked at this. Even when minorities earn very high incomes, many Black individuals end up accumulating far less wealth than their white peers. Now, why is that? That's because Black workers tend to offer more financial support to poor relatives, and in part because Black children are more likely to have taken out hefty student loans to pay for college. Both activities erode net worth and exacerbate the wealth gap. Now, the solution here, the policy solution with baby bonds is simple. The government would create investment accounts for infants, giving babies born to poor families large seed grants and babies born to rich families smaller ones. Again, the notion of means testing. The money would grow and the kids would gain access to it when they reached adulthood, used to pay for school, a down payment, and again, perhaps a startup. And according to Derek Hamilton of Ohio State, at the root of the racial wealth gap and wealth inequality in general is capital itself. Baby bonds are specifically aimed at giving people that seed capital, that early asset that passively appreciates over their lifetime. And there have been studies hypothetical to look at what this infusion of capital over time might do to address wealth inequality. Be sure to hit that subscribe button and to tune into episodes of What's Next with Money. And did you know you can get a copy of this 6-page PDF, How to Take Control of Your Finances? You can find a link to it at what'snextwithmoney.com, or in the comments section below, we also include a link. We're here giving you 2 ideas being talked about to close the wealth gap for your children, and 2 ideas you can implement now. Now, some of these, again, are policy ideas, and you don't have to wait on the government to pass something. But let me just say, each of these concepts, Roth at Birth and baby bonds, have generally been, and here's the good news, bipartisan. Prominent senators from both parties, congresspeople from both parties, have looked favorably on these ideas as sort of a neutral ground to address some of these big issues of wealth inequality. Here's the second idea to address wealth inequality that you can do right now, and that is to set up a 529 college savings plan for your child. These are administered by the states, and they can be used in many ways to save for education and training. Even adults can use these. So check with your state to see how that is, but you could actually cross state lines and enroll in another state's 529. They have many advantages, and in some ways, they're an improvement over other methods like a Uniform Gift to Minors Act. A 529 savings plan gives you tax-advantaged accounts specifically designed for educational savings. You can take withdrawals from a 529 plan to pay for qualified educational expenses at the elementary through high school levels, or for college level and beyond, even graduate school, or other kinds of training that's not even college-based. At the college or graduate level, funds can be used to pay for tuition, fees, books, supplies, and approved study equipment, even room and board for a full-time student at an accredited institution. There is no federal income tax on the investment gains of the money invested in these plans. And typically, a parent or grandparent opens the account and names the child or other loved one as the beneficiary. And as mentioned before, adults can open an account for their own qualified educational expenses. Here's some other features. A 529 can alleviate the impact on financial aid. A lot of families worry that saving for college in these accounts could mess up their chances of receiving financial aid, but 529s are considered parental assets. 529s have fewer restrictions than other college savings programs. They have no income or age restrictions. Anyone can open and fund a 529 savings plan. The student, the parent, grandparents, or even other friends or relatives. They control the money and choose among the investment options. And unlike some of the other custodial account education programs, the account owner, not the child, calls the shots on how and when to spend the money. And of course, there are the tax benefits. And let's close the wealth gap for retirement. How to close the wealth gap in retirement savings. We're going to talk about actions you can take now, strategies you can plan for tomorrow, and what America can do about this significant wealth gap. And for a lot of Americans, retirement, it's not really gambling, but it's sort of rolling the dice. They may not be prepared, they may not have a plan, and many times based on income levels and other reasons, the opportunity to plan is diminished. So saving for retirement is possible, but many of us are challenged to save and invest for something that can last as long as our working lifetime. So how can you optimize retirement and navigate the sometimes jigsaw puzzle of retirement options, decisions, and choices as we live our lives and we move from career to career, job to job, and retirement savings can be lost in that process. Today, we're going to give you 4 ideas being talked about to close the wealth gap for your retirement and ideas you can implement now. Welcome to What's Next with Money, a program about recognizing and moving on from financial regret, missed opportunities, and bad advice, because within these crises lie the seeds of learning and hope. This program holds the promise of second chances, strategies for growth, and financial empowerment. Let's get started. Racial minorities have a retirement savings gap with their white counterparts. It's a fact. But this retirement wealth gap is bigger than race. Half of Americans may not be able to keep their current working and income-based standard of living in retirement. This is according to the Center for Retirement Research at Boston College. The median retirement savings for white households, and this is kind of a band of ages 25 to 61, the median retirement savings is just under $80,000. For Asian Americans, it's $67,000. Blacks, $29,000, and Latinos, $23,000, according to the Economic Policy Institute. And here's more. People of color, on average, have less in retirement savings than whites. 1/3 of white households have no retirement savings, and more than half of Black and Latino have none as well. Not to mention lower minority homeownership rates. In this case, for retirement, they cannot access a reverse mortgage if they need one, or a home equity line of credit. And there are also inherited wealth differences among minorities as well. So bottom line, the majority of Americans are not saving enough for retirement. Underlying income and pay disparities among minority workers, less savings, lower lifetime earnings also contribute to these disparities, and it leads directly to lower Social Security payments. Without other sources of retirement income, there's a heavier reliance on Social Security. So America's patchwork of retirement planning, investing, and savings create challenges even for the most savvy investors and savers. And note, we've covered the wealth gap in housing and the wealth gap for your children in other videos, and we have those linked below in the comment section. We're talking about how to close the wealth gap in retirement savings. And here are the big realities. 1/3 of white workers do not work for employers that offer workplace retirement benefits. That's like a 401k. And it's just under half, 46% for Black workers and 65% for Latino workers, according to the National Institute on Retirement Security. They can't benefit from an auto enrollment in a 401k, or if they're really lucky, a pension plan. And a 401k would often have savings matches and contributions from the employer. So we're talking today about giving you 4 ideas being talked about to close the wealth gap for your retirement, and ideas you can implement now. Here's number 1, universal access to retirement savings at work through automatic enrollment. And automatic enrollment really works. So we're talking about addressing the coverage gap is one of the biggest problems with retirement savings in America. And states want to get involved in this issue. They want their older citizens as consumers and taxpayers rather than being dependent on a social safety net. And the way they're looking at this in many states is called the Auto IRA, where workers are automatically enrolled, and in most 401k plans now, that's the way it's set up, and it really works. People are, when they join a new position, they're automatically enrolled in the retirement system unless they opt out. They have to say no. And guess what? Most don't do that, which is great. And it's working to increase retirement security for many. But in these state programs, they're auto-enrolled within businesses that have never offered a 401k or anything else. They're enrolled in a Roth IRA, and they make automatic contributions through the year. Now, they can opt out, but a key factor for these small businesses that would offer this is there's no employer match. So it's really just the savings of the worker. But there are already bipartisan ideas to expand the auto IRA concept around the federal government. But if you are in a select set of states, you don't have to wait for a federal solution. Right now, 13 states have or are in the process of setting up auto IRA programs, with Oregon being one of the most thoughtful and innovative. And I'm going to have a link to all the progress states are making so you can get a contemporary update of which states have auto IRA programs and which states are considering it in the link below. And this is through the Center for Retirement Initiatives at Georgetown University. So workers who take a job where there's no workplace-based retirement programs are auto-enrolled. They go into a Roth account, and here's the cool thing about the Oregon program. The first year's savings are in a stable value fund, kind of like a money market fund, which avoids the stock market volatility and the scariness of the stock market. This first year of savings shows the employee who may never have set aside money for retirement that savings is possible and that savings can grow, and it's empowering. And to me, as a certified financial planner, a necessary step to set a new level of financial belief, self-confidence, and empowerment. After the first year, the newly invested money goes to a target date or index fund, into stock investments, equity investments. Yes, there's more volatility, but there's a greater potential for return and long-term growth spread out over many years as one saves and invests for retirement. Now, Congress on the federal level has had many proposals to add an auto IRA feature through federal legislation. And just as right now they've encouraged auto enrollment to existing 401ks. And as I've said earlier, that really works. It's one of the greatest changes in helping boost retirement savings for many, many Americans. But if your employee doesn't offer a 401k, then what do? You could actually create your own regular or Roth IRA and automatically send money each month to it from each paycheck, for example. So people could do this on their own, but most Americans really don't. They need kind of a help, and workplace-based savings is the main way that most folks do it. So remember also the upper limit is of earned income for a Roth or contributory IRA is $6,000 annually. So you can't really save more than that. If you're over 50, you can pop that up by an extra $1,000 to $7,000. That's called a catch-up contribution. Now, folks that are on their own in a small business, like a small business owner, self-employed individually, can do something even more spectacular. They can set up a SEP IRA, SEP IRA, and the contribution amounts can be much higher than the $6,000 or $7,000 for an IRA. And there are also something called a solo 401k, and that can be done where you have a person with no employees can set up kind of their own 401k just for themselves, also with higher contribution limits than the IRA. So there are all alternatives, but each one takes affirmative intentional action, and it's not automatic. So today we're talking about giving you 4 ideas about closing the wealth gap for your retirement. Here's number 2, portable retirement savings. Portable retirement savings, otherwise known as portability. Leakage from retirement accounts as people move from job to job. They might take out a 401k loan. It really should be paid back to keep that compounding and savings going, but sometimes they're not really paid back as people leave jobs. And so that's a form of retirement savings leakage. A big area is not rolling over to a new 401, when you change jobs, not rolling it over to a new 401k account at your new employer. And sometimes that is allowed to be a direct rollover. Or you can do a rollover to an IRA, a contributory, or Roth to receive that 401k money as you move from job to job. But a lot of times, if there's a gap in your employment, if you're not going from one job to another, that's where leakage happens. Another form of leakage is cashing out the money from a 401k or retirement plan for emergencies. And whenever you take money out into your possession, there's a 10% tax penalty. And in most cases, you also have to pay taxes on what you took out. Here's another form of leakage, and this is really basic: not contributing at all to a retirement plan. Or sometimes this actually is a wise move if in your household a family member has lost their job and you need to free up cash flow and to make your take-home pay much larger. But when that emergency stops, when that other person in the household regains employment, you want to start contributing again and maybe even catch up on your contributions. But when you don't contribute, you're not getting any match from your employer and you're missing out on compound returns. So we really need auto portability to combat leakage, to make it seamless as you move from place to place, and also have other ways to save for emergencies. So much like Social Security, this follows you as you move from job to job. We really don't have that in the defined contribution workplace retirement savings world. And this is really important for accounts with low balances. They tend to get lost. So when we think about forced savings to close a wealth gap in retirement, we want savings to become automatic with portability, so we don't have to think about it. And yet, no, we're making progress and feeling a sense of momentum to grow our financial confidence and security, the security of our own making. So other forms of forced savings you may not think about are things like mortgages. Hey, we pay a lot of interest to the banks, but the mortgage allows us to build equity and really forces us to take part of our paychecks and save that money in the home. And there are ways to extract that money and use it to build wealth and financial flexibility later. Even a tax refund is a form of forced savings. And you can split your refund and take part of it into a Roth IRA or a contributory IRA or even an emergency savings account. Even use it, part of it, to pay off debt. And a great thing that a lot of companies are adopting from some of these great innovators that we talk about, and folks I know around Washington and in the financial services field, is a sidecar or rainy day account or fund. So this is emergency savings in an account that goes alongside with one's regular retirement plan contribution at work. This will really lessen leakage and lessen the need to borrow or cash out of a 401k because you have an emergency fund you can grab versus raiding your 401k. We have a viewer question here from Corinne. She says, I don't make enough money to save and I really can't think about retirement. Well, thanks, Corinne. Life expectancy, you want to realize, is growing, and retirement savings is your future paycheck when the paychecks stop. Now, Social Security will help, and it's fantastic. And it'll be a baseline for recurring expenses. But we always have the rise in healthcare costs, and even out of Social Security, premiums are paid to Medicare for that. And you also have out-of-pocket costs. So a few tips for you, Corinne, is to look at jobs that offer 401k or auto retirement IRA type benefits, just to get your feet wet, get started. And you can start very small. If you're earning any money from the gig economy, consider that as extra income. Try to save some of that, even to start an emergency fund. And if you work at a place that has employee benefits, look at education and training for what you might like to do in the future. Add to your skills and talents. Even open yourself to be retrained to increase your income. And later we'll offer a free PDF that'll give you more ideas to do that. And be sure, folks, to hit that subscribe button. You can send a viewer question in. We'd love to hear from you. You can send that to whatsnextwithmoney.com, our main website, or at the YouTube link in the comments section below. We're talking about 4 ideas to close the wealth gap for your retirement. Here's number 3, essential elements to close the retirement savings gap. Now, some of these are policy ideas, but you don't have to wait for the government to implement them. These can be done by families and different generations of family members pooling their money. My friends who have worked at the AARP, Brookings Institute, AEI, Heritage Foundation, the Treasury Department have pioneered many of these concepts in addition to the Auto IRA. And here are a few. Auto enrollment. This is the thing that's working. It's really saving our defined contribution retirement plan in America. It really does work. Auto escalation. That would be like the percent you might identify to take from a future paycheck increase. This is the concept of save for tomorrow. I don't have to do it out of my paycheck right now, but I can do it from a future paycheck. And I feel better about that if I don't have knowing that'll come out of my paycheck a year from now. But I've predetermined, I've auto escalated, that decision will be automatic. I don't have to think about it. And then when I do contribute my retirement money, it might be auto defaulted, an auto default. This is, what does my retirement money go into? What mutual fund, index fund, or a target date fund calibrated to my age and my kind of estimated retirement date? The federal government already allows companies to do this. So they've been making great bipartisan moves to allow more flexibility and creativity from our financial services industry to aid and support employers who want to provide retirement security for their employees. Auto portability, we just talked about that. To help stop the leakage and keep the savings and investing momentum rolling. Auto annuity. This is a new feature also recently authorized that companies can do. And this is, you're nearing your retirement date, you have a new option. Instead of taking a lump sum, you could take part of this in the form of a paycheck. And you can set the date when those paychecks start. And the later you set those dates, in the principles of an annuity, the bigger those checks are. And you don't have to annuitize all of the lump sum. You could just do part of it or the full amount. It gives you a lot of flexibility. And you don't have to be a financial wizard to manage that, because you're not managing a lump sum. You've elected to receive this incoming pay to supplement Social Security. So many of these concepts are based in behavioral finance. It's a really cool branch of economics, or something we call choice architecture. The design of decision-making is set up automatically for you. You don't really have to make the choice. The optimized choice is made for you, but you still have the freedom to change that. Richard Thaler, a 2017 Nobel Prize winner in economics, and Shlomo Bernardzi, a UCL professor, great behavioral finance experts, they know that there are a lot of variables that can optimize this auto-retirement world, one that we're kind of moving to. And it helps us not miss out on the compounding effect of real returns that can really help anybody close the wealth gap. Here are a few examples. Does the auto enrollment apply just to new employees or to, let's say, existing employees, all employees? What's the initial savings level that's set? How much of that contribution is set in kind of the auto enrollment? What about the auto escalation? What is that percentage of future pay raises that will go to help increase those retirement contributions? And hey, when does that auto escalation part stop? Think also about the personalization of savings. This is kind of the messaging, like your retirement backpack as you go from job to job. It goes with you, and it encourages portability. Many great financial services companies offer messages, information about Social Security, coordinating how to save and how to set up retirement decision-making. We'll get into many of these on other episodes of What's Next with Money. Now, additionally, we like to bring you a lot of creative, innovative future thinking. And Professor Thaler, that Nobel Prize winner, has a dynamic yet simple idea he's postulated. It allows retirement savers to deposit part of their 401k into Social Security to increase one's Social Security checks. And it's like buying into that system, buying more in. Now, that's not law right now, but it's something that may be talked about, and it can be means tested. So this could be a wealth gap plug to help lower income workers, lower wealth workers boost their Social Security checks through depositing their 401k savings. Now, these are all highly creative, but we cannot forget the basics of optimized retirement planning to close that wealth gap. Here's some of those fundamental principles. Claim Social Security later. Let that paycheck from Social Security be as high as possible. Every year you delay claiming, it goes up 8% from age 62 to 70. Keep working, work longer. You can save more by doing that, and you don't have to tap into retirement benefits while those regular paychecks keep coming. Don't forget to upgrade your skills to align with your gifts and talents for better working income and thus more money to save for retirement. So we've been talking about 4 ideas being talked about to close the wealth gap for retirement. And we've mentioned before this PDF. You can get a free copy and download it, How to Take Control of Your Finances, at whatsnextwithmoney.com or in the comments section below in the link. We're giving you 4 ideas being talked about to close a wealth gap for your retirement. Here's number 4, what to do. You know, the good old days in retirement planning were not that good. You might say, oh, I wish we were back in a pension world. Well, there are problems with pensions. They were complicated. You had to stay with your employer a long, long time before you could be fully vested. And the benefits were backloaded to really reward longevity and people staying. And how many people stay in the same job for so long? So now we're in a defined contribution world where it's your savings. It's kind of your own pension, and you get perhaps matches from your employer. And pensions weren't as portable as 401ks. So we still have other challenges like Social Security. The payments can be lower because it's a premium, an insurance premium we pay through our working life. And if there are breaks in service, if there are years we don't work, that Social Security paycheck starts shrinking. And that can be through unemployment, caregiving, child rearing. This is particularly challenging for women. In fact, back in 2013, a National Committee to Preserve Social Security and Medicare study indicated that 1/2 of unmarried women counted Social Security for 90% of their retirement income. Half of unmarried. Now I think that number is probably less, but it shows you the importance of keeping Social Security as a powerful tool and still saving on the outside the best one can. To get more information about these and other issues with Social Security, contact ssa.gov. We'll have a link to that in the comments section. And then there's the issue of the challenge of tax advantage retirement savings. And that's really a big precept on what part of our retirement system is based on. But guess what? A lot of retirement benefits, even though they're tax advantage, they don't help people at the lower income scale because they don't pay as many taxes. So advice is challenging. How do you coordinate the retirement decisions with Social Security, 401k? What do I invest in? Should I annuitize or not? A lot of cases right now, it's a do-it-yourself retirement planning world. Now, many are seeking advice. We have links in the comments section for certified financial planner professionals that can help you. But studying, getting advice from HR departments, and even those who service your 401k is another place to start to get and collect information. We also have the issue of financial shocks. And there are many studies out that show how many financial shocks happen to a family over a lifetime. And these can come from divorce, disaster, a health crisis, certainly unemployment is a financial shock. And when these happen, retirement contributions drop or stop. And maybe it's your spouse who loses a job. And in many cases, that's where the other spouse, the one that's still working, might cut back on their retirement contributions or stop them altogether to make their paycheck bigger to make up for that void from the non-working spouse. Now, that actually can be a smart and prudent financial planning move, but when the spouse is reemployed, who had lost his or her job, you should start recontributing or even doing catch-up contributions if you can. And even companies stop 401k matches in a downturn. This is actually very common as their revenues and economic activity drop. But when they pick up, and we've just seen this recently in the COVID crisis, they often restart those matches. And that's really an interesting economic indicator of financial health of the company. But the good news is, even in this pandemic that we've gone through, or going through, there's been retirement savings resilience. It's appeared, and less money has been pulled out of retirement funds than any of the previous big recession like the housing recession or the Great Recession. So folks are getting the message in America that we're really on our own for retirement savings. We've got to make smart Social Security decisions, but we can't rely just on Social Security. That's rolling the dice. So another problem, blue-collar Americans, often they retire early. They're less physically able to do their jobs and need to find something else to do, but they really pull out of the retirement system a bit early. But hey, problems happen with the white-collar workers as well. When they lose their jobs, very often it's hard as they're older to find another job with the same salary or even close to the same salary, much less benefits. In some cases, they're almost nudged out of the workforce, given early retirement offers, or they're just plain laid off. So savings, very, very important. And let's talk about the power of savings. And this is really, hopefully, the moral of the story of today's episode. This book, The U.S. Financial Diaries by Rachel Snyder and Jonathan Murdoch, is one of my favorites. And it shows that Americans can save. And even through the unpredictability of their income, the uneven consumption in their lives, but the steady march of bills every day, every week, every month. And what happens? It becomes a mismatch of income and expenses. And folks in this situation often have limited access to financial services, and the financial services they might have come at a higher cost. They are adept at pooling their money. So income is pooled from different jobs, different people in a family, even boarders, that are not even regular family members can kind of do this to pay the rent or the mortgage. So spending money is set aside on what is known as a high frequency basis. Agnes Deaton, a Nobel Prize winner, and Professor Michael Sheridan of Washington University in St. Louis have pioneered the idea and have honored the great financial literacy and creativity of low-income workers, people that live money week to week, month to month. Folks at the financial edge of life are some of the best money managers around. They're highly aware, highly intuitive about money, and they're highly innovative. But this kind of creativity takes time, and it's tiring. Much less if they don't have good access to transportation and have to spend longer times just even getting to the work that has uneven hours and unpredictability. Now, to help close some of these gaps, a few folks in Congress and at think tanks are even looking at the U.S. Postal Service, yes, the post office, as a financial services hub for lower income and low wealth workers. Years ago, there was a postal savings stamp methodology that they used in the post office. And you could create postal banking accounts, savings accounts for emergency funds, check cashing, even small dollar loans. And another creative idea occurred in the Obama administration without the need for Congress's involvement, and that was at the Treasury Department. They created something called the MyRA, that's MYRA. And it was a starter on-ramp retirement savings account. And it kind of automatically saved in what is known as like a savings bond. So it's very steady and predictable, and it would allow people to save up to $15,000. Now that program went away, but it could come back administratively. So many creative ideas. And you know, we talked about rolling the dice in retirement. Actually, this is a set of retirement dice. It's real stuff. The big goal here is to structurally turn retirement savings into an automatic, efficient, and effective forced savings, kind of like mortgages and tax refund. Retirement that follows you, that's portable. In America, we can fix this. And many of the ideas that I've mentioned, the cool part about it, they're mostly bipartisan. There's very little party disagreement among these concepts. And we do have the capability to pull this together. So we've been talking about these various ideas to close the wealth gap for not only your retirement, America's retirement. So keep watching What's Next with Money, and we will address savings, investing, ownership, and we place this in context with what's happening, the on-ramps for financial success, closing the wealth gaps, the latest future thinking in DC and from around the world.